There are 4 key investing strategies when it comes to commercial real estate, but which one is right for you? Which one is going to give you the highest returns and which one's going to carry the highest risk? Well, in this video, I'm going to explain and walk you through the 4 key investing strategies so you can make the best educated decision as you scale your real estate portfolio. And as I break down these 4 strategies, I'm going to order them from the lowest amount of risk to the highest amount of risk, and then we're also going to talk about returns later on. But let's start with the risk first. Now, the first strategy I want to fill you in on is called core. Now, the core strategy is all based on location, location, location. Imagine the biggest, most successful city that you can think of. And now think of that city and the best piece of real estate, the prime central location that everybody would want to own. Well, this is the key concept of the core strategy. You are acquiring the best premium asset in the best location in the middle of the city. This is why it's called the core, because you're literally in the core. Now, there's nothing wrong with the asset. There's no work to do. You are buying a pristine building that has no deferred maintenance. It's probably a new building. It is the best piece of real estate that you can own in that location. What are you going to do with that? You're going to own it, and you're going to sit on it, and you're going to manage that building as best as you can. Because eventually, as the city builds up, that area is going to become even more and more in demand, and the market is going to push the value of that asset up along with it because you own the best piece of land in town. Now, with the core strategy, you're thinking of a long-term hold period. So in terms of the length of the investment here, the core strategy, you are in it for a long time. So you're at this end of the spectrum. You're not going to buy a core asset and flip it after 6 months. That's not what the core strategy is all about. It's all about finding the best piece of land, the best building on that land, managing it and holding it for a long period of time because, like I said, over time, the market's going to push it up and your value is going to increase. The second strategy is called Core Plus. Now, it's very similar to the core strategy, but here you're looking for an asset where you can do a little bit of work. I'm not talking about huge renovations, you're not knocking things down, you're not totally rebuilding the asset, but you're looking for some things to do. So maybe it's a rebranding exercise where you're changing out the awnings, changing out some exterior things just to make it more appealing. You're still buying the asset in the best location you can get. You're still buying a great building, but there's just some changes, some work. I call these lipstick renovations. You're not making major changes with the asset, but you're just doing a little tidying up and just improving it. And with the Core Plus strategy, it carries a slightly more risk because you are making some changes, you're modifying the building, you're not buying the absolute best asset that you can find. You're buying a really great asset, but there's a little tinkering that you can do there. So in terms of game plan, how long are you going to hold this? Well, with the Core Plus strategy, you're going to hold it for almost as long as you would hold a core asset, generally speaking. Buying a great piece of real estate, great location, you're doing a little bit of work and you're holding it for a long period of time. Now let's move on to number 3, and the third commercial real estate investing strategy is called value add. And the core concept of the value add strategy is all about finding problems and fixing those problems. So there's really 2 ways to drive the value of an asset using the value add strategy. On one side, you're going to do physical changes to the asset, physical renovations. It could be doing renovations inside. It could be doing exterior renovations, adding amenities, converting spaces. You're doing things to the actual asset. And then on the other side, we have operational efficiencies. Maybe it's changing management, changing the strategy of the asset, changing the marketing, adding, in the case of residential properties, energy efficiency. These are the things that you do in terms of the management of the asset, not the physical asset itself. Now with value add, like I said, we are looking for problems to solve. We are looking for assets where they are performing below where they should. They're not meeting the standard of the market. So maybe you're acquiring an asset that was built 20 years ago. The plan is to do some renovations, change up the management style of the building, and that is how you're going to manufacture the value of the asset. So unlike Core and Core Plus, where you're doing either no work or a little bit of work, and you're really relying on the location you've selected and the prestige of that location and the building to drive the value of the asset up. With value add, you're relying on your actual work to go in and your ability to do the right type of work to make that asset more desirable and improve the NOI, the money produced by that asset each and every month and every year. And that is what's going to increase the value of the asset. So a lot more work involved. You have to find the right type of asset and make sure you have the right business plan to go in, do all the fixes on the physical side and the operation side, and make sure that you can hit your targets and earn the return you're looking for. Now, in terms of how long I'm owning this asset, well, if it's a core building, maybe you're going to own it for 15, 20 years, right? A core plus asset, maybe you're holding it for 10 years. A value add deal, generally speaking, you're going to be holding it between 3 years and 7 years on average. That's the general hold period for a value add type of deal. So you're in this type of range here in terms of how long you're holding onto that asset. And number 4 is called opportunistic. Now, opportunistic, this is where you are hunting for the best opportunity you can find and you're acting very, very quickly. So for example, maybe you come across an office building, everybody's moved out, they're in financial trouble, they're about to default on their loan, you move in, you have the money ready, you pull the trigger, and you have your business plan with how you're going to turn things around. Somebody's in distress, you find it, you're going to take action. That's opportunistic. Maybe there's a multifamily property, it was ravaged by fire, 70% of it is unoccupied, major issues, you have the money, you're going to come in, you're going to do all the work that you need to do. It's capital intensive, it's effort intensive, it takes a lot of skill, it incurs a lot of risk, but you're going to do that deal because you know the returns are juicy. This is an opportunistic deal. You're just looking for the best opportunity, you're willing to take the risk, but you know you can execute, so you're going to do it. So in terms of how long are you going to hold an opportunistic type of deal, well, you're in this range right here. Some people will acquire a deal like this, do the work, make the impact, and sell in 6 months. Other people will hold it for a couple of years, but generally speaking, you're in the very early stages, or you're getting rid of this thing once you go in and fix the issues. So we talked about risk, right? With opportunistic, you're doing these capital intensive deals, you're fixing some major problems. That's going to carry the highest amount of risk. Compared with core, you're buying, right in the downtown of New York City with the newest and best building. Well, you can see how the risk definitely changes between core and opportunistic. Right now, how does that impact the returns investors expect and the returns you as the operator would expect? Well, there's always that balance between risk and reward. Some people are willing to incur a higher risk in exchange for the possibility of earning a higher return. And this is the balance and this is the ebb and the flow. Now with a core type of asset, an investor, in exchange for the lower perceived risk here, right? Because it's in the best location, the best asset, there's less things that can generally go wrong. As long as you hold it for a long period of time, you're probably going to make some money here. So an investor, in terms of looking at, hey, how much am I willing to accept in terms of returns, is generally going to be able to accept a lower return in exchange for the lower risk. Now, at the other end of the spectrum, an opportunistic play, we're going in capital intensive, we're fixing major issues with an asset. Well, in exchange for that higher risk profile, the investor is going to want to earn a higher return because they're putting their money at greater risk, right? So you can see that there's that balance in the ebb and the flow. The higher risk somebody's incurring with the strategy, while the higher returns they are expecting. Now, a lot of people ask me, hey Seth, well, what's your favorite investing strategy out of these 4, and which strategy should I use? Well, the answer is, well, it all goes back to what are you trying to accomplish? What type of portfolio are you trying to build? And also, like, what type of investors are you looking to attract? If you're somebody who has a high skill set and you have the capital and you know you can execute and you're willing to take that higher risk, well, you're probably going to look at an opportunistic play. If you're looking to go in and solve some major problems, well, this is for you. But now your investors, you're probably going to be attracting people who are able and willing to take that high risk in exchange for a potential high payout in terms of the returns. On the flip side, a core investing strategy, well, steady Eddie. steady, right? We're going to hold this asset for a long period of time. We're going to buy the best deal we can in the best location. I'm okay with lower returns, but my money is safe because the risk profile is low. Personally, for me, I prefer the value add strategy. I think this strikes the best balance between risk and reward. Yeah, we're not taking opportunistic risk here, but we're not just locking in our money in a very low risk where there's nothing we can do here to add value to the asset. So with the value add strategy, like I said, we do two things. We improve the physical aspects of the property through renovation, interior, exterior, amenities, and we change the operations, how the property is actually functioning, and we can change management, all that type of stuff. For me, if we find an asset that's a great asset, but it's just mismanaged or it hasn't been renovated, if there's something missing that's keeping it from achieving its full potential, well, value add is exactly where you want to be. You're buying a good piece of real estate, there's problems to fix, you go in, you fix them, but you're not incurring all the heightened risk of the opportunistic play. And if you're interested in knowing how you can structure these types of deals, all the different avenues that you can explore and how you're going to put these deals together, well, check out this video right over here where I walk you through how to structure real estate deals.